Everyone, good morning. Today we are going to start with we are going to talk about something which actually affects your education, your job, your loan, your savings, your house, and even your price. The prices you pay every day, the rates. So you do not need to be from the finance background to understand this lecture. And in fact, this lecture is designed for students which are actually which are from outside finance background, and because these ideas affect everyone, not just investment bankers and investors. So you do not need to worry about not being from finance background. So let me start just with a simple question. Why do people would prefer 1,000 rupees today rather than 1,000 rupees 1 year later? So if you were given a choice to have 1,000 rupees today or 1,000 rupees after 1 year, so you would prefer 1,000 rupees today because you can use it now, or because maybe the prices may rise, or because of the uncertainties in the future, and all of this is correct. Uh, and all of this is about the rates. So why rates matter in the economy is, so rates play a very central role in shaping how the economy functions. They influence whether the market, whether the households save or spend. They influence whether businesses invest or they wait to invest, whether people buy homes or delay, whether economies grow fast or slow down. And at the core, rates represent the cost of the time, risk, and uncertainty. When rates are low, borrowing becomes actually cheap. And because of the cheap borrowing, people start to spend more, businesses invest more, and jobs increase, and asset prices rises. Asset prices rises because of the supply and demand factor. When rates are high, or when the rates rises, borrowing become expensive. People save more, businesses delay investments, and growth becomes slow. And because of all this, the markets fall, or markets may fall, or markets stabilize, or correction also. Uh, this is why the changes in rates can create boom, cause slowdown, or trigger financial instability. This is why understanding the concept of rates is very important. And for that, we need to understand the concept of discounting. The concept of discounting. Uh, so now let's understand the concept of discounting. A discount rate is actually a rate which is used to convert the future money into some value today. So what should be the value of that money which I'm going to get in future today? This is the current value, and also known as the present value. Uh, I think in elementary or in junior year, when you were in school, you might have read about the formula that present value is equals to future value, and there was a rate involved, 1 plus r to the power n. So what does this means is that this is actually representing the time value of money, time value of money. And what does this equation means? What I mean to infer here is that whether you can save this money, you can invest this money, you can use this money to earn returns, um, or example, let's assume that you have 1,000 rupees today, and in future, if this money does not increase to, let's say, 2,000 rupees, and I'm not assuming 1 year, I'm assuming more than 1 year. If in future this money is going to be 2000 rupees, so what should be the discount rate and how much should you invest today? So to understand this thing, at what rate should you grow? So discount rate is basically the rate at you should grow in the X number of years, X number of years to make this 1000 rupees investment to 2000 rupees. If this was 1 year, so it's almost 100%. But what should be the rate? So that's discount rate. And if in future you are getting 2000 rupees, how much should you have right now to how much should you save right now and to get the 2000 rupees in the future? So basically, this is a simple example. And for to calculate this thing, the most essential element is the rate. So you need to have a rate to calculate these values. And these values are actually influenced by uncertainty and risk. Example is that the future is never guaranteed. Job may not continue, business may fail, projects may not succeed. And because of the future is uncertain, we reduce the value of the future money. And because of the time value plus the risk involved, the future benefits and the costs are always worth less than the immediate ones. So the formula initially was future value is equal to present value 1 plus rate to the power n. And I'm saying that in future, if I am assuming today is it's 1000 rupees, and in future after 1 year, I am expecting a rate of 10%. I am expecting a rate of 10%. So I would want to the power n. N represents year. So I am expecting the future value. I am expecting it to be 1100 rupees. So this much should be the money that I should be getting. And discounting, we are talking about discounting, but what I have done here, it's compounding. So opposite of discounting, one upon discounting is compounding. Compounding. And if I were to bring it to the present value, so I will do a discounting. So this is pretty much simple, compounding and discounting. Okay. So why discount rates are used? Let's talk about why discount rates are used. So discount rates are used by their discount rates are used everywhere in investment decision, in asset valuation, in risk management, public policy, credit markets. In investment decisions, companies decide whether a project is worth of doing or not. So it's used. The discount rates are used to evaluate the future cash flows, the discounted future earnings. Uh, when we talk about asset valuation, bonds, real estate businesses are priced based on the future income. Uh, Risk management, when we talk about risk management, risky outcomes are discontinued more heavily. So if investment is risky, so we will try to discontinue that investment as soon as possible. Public policy means in the context of public policy, government compare today's cost with future benefits. And for example, if they want to build a highway or if they want to fight climate change, so they will actually they will decide using the discounting factors which project to prioritize, uh, and then they will decide. It will help the government to make public policy. And when we talk about in the context of credit markets, interest rates on loans are based on discounting future repayments. So if you have ever had a loan on you, a loan EMI or salary negotiation or education decisions, or let's talk, okay, it's important retirement. planning. So let's talk about first retirement planning. So how much should you contribute every month right now? Contribution. So that you can achieve your goals, your financial goals when you are 60 years of old, when you're 60 years old. So retirement planning, at what rate should you invest, at what rate, and how much should you invest so that you can achieve your retirement goal. When you talk about education, so education loan is easily available, and since we are talking about credit markets, when we are talking about rates, so you need to understand that education loan also, there is education loan also, and when you are educating, when you are deciding whether to get education in that specific field or uh, you want to have a degree, college education, so that's heavily, so college education is not cheap. If you want to go some Ivy League colleges, or if you want to go to a premier college, so those are expensive. And for that, uh, you look at the brochure of the colleges. So how much is the placement done? What is the placement after you're doing this program, enrolling into that program or completing that program successfully. So, and then you do the cash outflow in analysis and the cash inflow after achieving, after pursuing successfully that program. When you talk about salary negotiations, so salary negotiations, let's understand that if your current employer is giving you a 5% salary increase and the current inflation in the market is 7%, so would it be beneficial for you to have this, accept this, this percentage of salary increase, salary hike annually? So the answer would be no, because this, uh, if the inflation is rising more than how much you are, the salary is increasing, then you are not at a profit, but at a loss of, I mean, you will not be able to support yourself using the money which you are getting. So you need to negotiate accordingly, whether you want to switch to a different company, you want to start seeking different other options. So this is the time when people actually decide, because you have, this means that you have not grown, you have actually fallen uh, as an employee. And when we talk about loan EMIs, so loan EMIs are actually structured on the basis of uh, interest rates. And since we are talking about loan EMIs, in the next video, we will talk about amortization schedule also of a loan. I'll try to make a video about it also. So, okay, let's talk about the, the different type of rates and their rules. So, different type of rates and their rules. So, just understand this thing when we are talking about why discount rates are used. So, this is important. And the important idea here is that higher the discount rates, higher the rates, so lower is the present value, lower is the present value. And longer waiting time also means the present value gets low. So higher rate and higher time means lower present value. And this is why long-term projects are very sensitive to the rate changes. Tech companies are hit hard when the rate rises, and infrastructure projects depend heavily on discounting. Different types of rates and their rules. So different type of rates. So rates may come in the form of interest rate, discount rate, so policy, inflation, social discount rate, personal discount rates. Interest rate are actually the cost of borrowing or rewarding yourself for saving. So if you decide not to spend the 1,000 rupees earlier, which we discussed about, and you decided to keep it safely in your bank account, so you in the next year you will be rewarded for saving this money. And uh, so if the money is in the saving account, you will get a saving account interest rate. So discount rate actually, this represents how the future value how we value the future money today. So discount, I think we have discussed about discounting, and I think it's clear. So the thing is with this topic, the rates topic, is that it's not a very difficult topic, but it's very difficult to deliver uh, it in theory to somebody. And I'm trying my best to do this. So when we talk about policy rates, there are a lot of rates involved here, and rates are actually set by the central bank. So the policy rates, when we talk about the rates in the context of policy rates, these are the rates which are actually set by the central bank. And when we talk about the inflation, inflation actually measures how fast the prices are being rise. So purchasing power changing, that's inflation. When we talk about social discount rates, this is how the government value future generations, the future social welfare. When we talk about personal discount rates, this is how impatient or patient individuals are. So whether you want to enjoy today, or uh, you want to have benefits in the future with this money, so that's the personal discount rate. How do discount rates are built? Then this is relatively this actually is very important, uh, to be very frank. So when we talk about the rate, the discount rate, so first thing is the risk-free rate, which comes into the picture, and then we add an inflation component into that rate. Then we add the risk premium into that rate. Then we add the holding or admin cost, and the maturity adjustment. Okay, so let's understand this thing right now. Risk-free rate is the rate of a government security. If I'm saying that I'm having 1,000 rupees today, and the government risk-free bond has a rate of 2%, I'm saying that this, uh, whatever it is, I should be getting minimum 2% return next year on this money. So from finance perspective, it's a little tricky to understand, because when you're talking about personal perspective, we do not think about all these things. That if we have 1,000 rupees cash in our wallet, so that the next year that the value of that 1,000 rupees is actually going to degrade, not to increase. So that's why the money is actually kept in the banks, uh, preferably. So 1,000 rupees, if I am having 1,000 rupees, and if you are thinking it from a perspective of finance, you need to have at least 2% return, the risk-free return. This is known as the risk-free return, and risk-free is actually involved from a safer investment, and the example is the government securities. And after that, this 2%, there is going to be some inflation. So the purchasing change in the purchasing power of this 1,000 rupees. So you would want an extra premium of, let's assume the inflation premium is 3%. So at least you want 5% of rate return on this 1,000 rupees. So at least next year you want to make this 1,000 rupees to 150 rupees to enjoy the same amount of value. So next year, this should be 1050, or else the value of 1,000 rupees will degrade. And the third point here is that risk premium. So let's assume that so risk premium is actually accounting for uncertainty and possible losses. So here, let's think it from a perspective of a business. Those businesses which actually have a good reputation and those businesses which actually have a bad reputation. So if the business actually has a good reputation, good cash flows, they have been maintaining good books, so there is a possibility that they will get a loan at a cheaper rate. The risk premium is lesser for those banks which actually have those companies which actually have uh, good. I mean, those are companies which actually have lower risk, and the those companies which actually have higher risk means they are under financial distress. The cash flows are not certain, or maybe they actually have a bad reputation. So for those companies, the risk is going to be higher. The risk premium is going to be higher. Let's assume there is a company. Let's assume you are getting a bond. Let's talk from perspective of bond. Let's assume that you are buying a bond in Ukraine, maybe Ukraine. So there you will be requiring more risk premium because of the uncertainty, because of the war situation with Russia. And if you are investing in a uh, company which is located in United States, USA, so there the risk is relatively less as compared to the Ukraine situation, as compared to Ukraine. So there the risk is low. So understand about the risk premium. Uh, from that perspective, try to understand that. Holding admin costs, yes, there are going to be some obvious costs involved in processing the loan and all. Uh, it's subjective. It's relevant only when it's available, and in most of the cases, it's not relative. It's not relevant. But maturity adjustments. This means that if you are taking a loan for 1 year, the interest rate is going to be different. If you're taking a loan for 5 years, the interest rate is going to be different. If you're investing for 1 year, the interest rate is going to be different. If you're investing for 10 years, the interest rate is going to be different. And this is maturity adjustment. One thing which I'm missing here is liquidity. Liquidity also. So liquidity also comes with the risk premium. So think about it. If you are having a bond from a company which is defaulting, or you are having stocks of companies which actually have a history of default, or you have invested in the stock markets, or you have invested in the equity markets, or not, they are both the same thing. You have invested in real estate. You have a real estate property. You have a property, residential property. Because this property, not everybody will be able to buy this property because it's very expensive and a lot of capital is involved. And stock market, you can sell the stocks in the stock market, and the market is regulated here. Here, the market is not regulated. You actually have to find buyers to sell your property. And to be very frank, there are not going to be a lot too many buyers. But here in the stock market, uh, there will be buyers, and because of the interfaces now, they will be quickly sold. So this, what why I'm explaining you all this is because I want to understand what liquidity means. Liquidity. And if you are from finance background, so you would know what the current assets are and what the non-current assets are. So these are liquid in nature and these are not liquid in nature. I hope this much is clear. Now let's talk about. Okay, before that, let's discuss the present value in simpler terms. So, present value expresses how much a future amount is worth today while applying a discount rate. As the discount rate rises or as the waiting period become longer, the present value falls. And this explains why the long-term investments are highly sensitive to changes in the rates. And interest rates, so central banks influence economic activities primarily through policy rates, policy interest rates, and by raising or lowering these rates, they affect borrowing cost and saving behaviors, investment decisions, inflation, and overall demand. And changes in policy rates also influence the discount rates used by investors and firms throughout the economy. Uh, Beyond interest rates, there is one more very important concept, which is about quantitative easing and quantitative tightening. And this is how actually the government uses the interest rates and discount rates. Quantitative easing and tightening. This is how the government actually controls the flow of money in the economy. So central bank actually controls the economy mainly through policy interest rates. And by changing interest rates, they actually influence the loan costs, spending, inflation, investment, and economic growth. But sometimes policy rates are not enough. So beyond policy rates, quantitative easing and quantitative tightening comes into play when rates are already very low or during crisis, uh, like the COVID crisis, which we saw, central banks use quantitative easing and quantitative tightening concepts. The measures are used by, these are actually the measures. So quantitative easing is, this means that the central bank actually buys large amount of bonds from the market. So this is actually how the quantitative easing starts. And because of this, uh, the bond prices actually start to rise and the bond yield fall. And yields and the prices are actually inversely related. Long-term interest rates also fall because of this, and discount rates fall. And uh, just because of all, just because the central bank gets involved, the credit becomes cheaper and investment and asset prices also rises. The impact of quantitative easing on the market and the public is that for markets, the stock prices actually rise. Mortgage and loan rates also decline. Uh, Bond rates rise, real estate prices rise, and for general public, home loans become cheaper because of lesser interest rate. People would want to buy a home because this is the right time. Whensoever the quantitative easing happening, the loan actually becomes cheaper. And because of that, real estate actually gets a boom. Interest businesses hire more, jobs increase, but inflation may also rise. And assets owner, those who actually have assets, they might benefit. But the increase is actually there is an inequality increasing, potentially increasing inequality because of uh, high trade. When we talk about the quantitative tightening, so if you're following news, every now and then you might be hearing about quantitative easing and tightening happening in the United States. So recently uh, uh, they actually said that they are actually stopping. This was the last quantitative tightening, and now everything is okay in the United States. So try to keep updated. Just watch few news and all. Try to read newspaper or It's very easy these days. Information is available on social media also. So, okay, let's talk about quantitative tightening now. So, quantitative tightening is the reverse of quantitative easing. So, previously we were talking about easing things. Now we are tightening things. So, it's the reverse of quantitative easing. How it's done. So, central bank actually stops buying bonds and they start selling the bonds back into the market. So, this actually increases supply of the bond. And because of this, the price of the bond actually falls. Since the price of the bond has actually fallen, so the bond yield rises, the yield on the bond actually start to rise, and the discount rate also rises. This means that the credit becomes expensive and the investments actually slow down. So the impact of quantitative tightening on the economy is that for the stock market, the stock prices fall or become volatile and bond yields also rise. And for the public, EMI actually, the loan EMI actually increases and the mortgages start to become more expensive. Housing demand falls and firms actually start to delay hiring and inflation slowly decreases. I hope this much was clear. Uh, Quantitative easing and quantitative tightening. One thing that the prices of the bond are inversely related to the yield. This means if one rises, another falls. I hope this much was clear. So uh, now the next topic is capital budgeting and investment decisions, and this is an all new topic. We will discuss about this topic in the next session. Thank you for attending today's session. I hope you have learned something of value today. Thank you.